Hey guys, my name is Blessing Malambo, and today I'll be helping you genius up with accounting. So today we'll be doing grade 12 accounting. This is a 2021 question paper. It was a June question paper. So today we'll be doing question one, which basically deals with like a transaction analysis and audit reports, right? So just the basic of like accounting. And this is the starting point. If you understand the key principles here, then going forward, accounting will be fun for you, right? So we'll just do question one, and then I'll upload other videos which focus on the rest of the question paper. So let's start with question 1.1. So question 1.1, they gave you this question whereby they give you sentences with options to choose from. So you have to choose the most correct weight here. They say choose the correct weight from the weights given in brackets, right? So this is like the simplest form. I'd expect you to score 3 out of 3 on this one, because if you understand the basics of accounting, then this is definitely where you score marks. So let's start 1.1.1. So they say the concept of limited or unlimited liability ensures that shareholders are not responsible for the debts of the business in the event of bankruptcy, right? So you have to understand what is limited, what is limited liability and what is unlimited liabilities. So these concepts, they come about when you talk about business structures or the type of structure the business is in, whether it's a company, whether it's a partnership, whether it's a sole trader. So usually limited liability, it means that the liabilities of the business are limited to the business only, meaning that it's usually applicable in business structures such as companies, whether public or private, whereby the liabilities of a company are limited to the company only. So what happens here is the company operates as a separate legal entity, meaning that it can enter into contracts on its own, and it can operate on its own, independent of the owners. So in this case, it means that if a company enters into debt which it cannot repay, and it has to declare bankrupt, owners won't be affected. The personal assets of the owners won't be affected, right? Only the business assets will be affected. But the concept of unlimited liability, it means that the owners are also personally liable for the uh, debts of the business, right? So if the business enters into a contract and then or a debt, and then it's unable to pay back that debt, it means that the owners will be personally liable, meaning that if the business cannot settle that debt, the owners will have to pay that cash out of their own pockets, out of their own money, using their own assets. So that's the difference between limited and unlimited liability. Limited, the liability is limited to the company, and unlimited, the liability can cross over to the owners of the business, which can be, is usually applicable with the unlimited liability is applicable in like a partnership and sole trader, whereby the owners are personally liable, meaning that if the partnership cannot pay whatever debts it's in, the partners will have to pay that debt from their own money, from their own pockets, right? So the answer here is limited. Why? Because they say shareholders are not responsible for the debts of the business. So limited, the liability is only limited to the business, not the shareholders, not the owners, right? And 1.1.2, they say when preparing financial statements, creditors will be reflected as trade and other. So the answer is trade and other payables. So you need to first understand what are creditors. Creditors are people who owe, right? Are people who owe money, or we have an obligation to pay them something. We owe them, like those are creditors. So they're payable, right? Because we're going to pay those creditors. So it's trade and other payables. That's how we classify them in the balance sheet or in the financial statements. And 1.1.3, it says the separate disclosing of significant items such as interest expense is an application of the prudence or materiality gap principle. So prudence, it has to deal with overstating amounts in our financial statements, right? So the prudence concept gap principle, it says you cannot overstate or understate amounts in the financial statements, meaning that you cannot overstate income, you cannot understate expenses, meaning that you must reflect expenses and income just as they are. Same with assets and liabilities. But the concept of materiality, it says you must disclose or you must show separately significant items or significant amounts, right? If you've taken out the loan of 500,000, that has to be disclosed separately, meaning that it has to have a line item in the financial statement. We have to say that loan 500,000. It's not like those small things that can be grouped together, such as you remember when you were in grade 10, you have an account of sundry accounts, so I would put all those, the summation of all the little transactions that happen, right, which are not significant, so we include them there. So the principle of materiality says if the transaction or if the item is significant, meaning that it's huge enough that it can impact or it can affect the decision of someone who's using those financial statements, it must be disclosed separately, meaning that it must be, that's why it's material. In a way, we say that item is material. In a way, it's too big or it's significant in a way that it's important. So it must be disclosed separately. So you know that when we deal with disclosing significant items separately or disclosing them separately, that's materiality, because those items or those transactions are material, right? So the answer here will be materiality. And then you get your 3 marks, your full 3 marks, right? And let's move to 1.2. So with 1.2, this is where we do this thing. They say analyze the transaction below according to the headings on the table provided in the answer book. So this is an accounting equation, right? So it's an accounting equation. That's when you have to determine the impact of transaction on the different on the accounting equation, which is assets, owners, equity, and liability. So the accounting equation is assets is equal to owner's equity plus liability, or owner's equity is equal to asset minus liability. So we'll get to it. So let's just read the question. They say analyze the transactions below according to the headings on the table provided in the answer book. Indicate account debited and account credited in the general ledger. So the account, you have to give the name of the account debited and the account credited in the general ledger, and the effect on the accounting equation, whether assets have gone up or down, whether owner's equity went up or down, whether liability went up or down, right? And then another thing, you need to indicate an increase as a plus sign or a positive sign, a decrease as a negative sign or a minus sign, and then no effect as 0. Refer to the example provided. So they say assume a favorable bank balance at all times, right? So they say bought stationery on credit 3,200, and then they said the account debited is stationery and account credited is credit has control, and then amount is 3,200. So let me just break this thing down. Let's break the example down before we even go to the question itself, right? So thinking about the accounting equation, there's this rule I used to use that used to help me when I'm answering accounting equations, right? So it is so we have increase, and then we have a decrease, and then we have, they call this rule Ali. So you just have to do this. You just have to write Ali as in ALIE, right? So the same thing this side, you have Ali. So what happens here is you have to write it like this and say plus, this plus indicates an increase, and then this minus indicates a decrease. So it has Ali. So you have to know that assets, This plus over here indicates an increase, and then this minus indicates a decrease, right? So Ali, A stands for assets, L stands for liability, I stands for income, and E for expense. So it's asset, it's liability, it's income, and expense, right? So that's what Ali stands for, right? So after you have your plus, your minus, and then you have Ali on both sides, now you have to just remember one thing. So what you have to remember is the first thing here, the first A, where does assets increase? So assets, they increase on the debit side. So this is the only thing you need to remember when using this diagram, because after you can just say D. Once you say D, C, C, D. So it's credit, debit. So it's D, C, C, D. And then this side is the opposite of that side. So if you have a credit here, if you have a debit here, you have a credit here. Then you have a debit here. You have another debit here. And then you have another credit here. So this diagram basically summarizes the type of accounts you have and where they increase or decrease. So assets, they increase on the debit side. Assets, they increase on the debit side. Liabilities, they increase on the credit side. Income increases on the credit side. Expenses, they increase on the debit side, right? And this is just basic diagram. Assets increase on the debit side, they decrease on the credit side. Liabilities increase on the credit side, decrease on the debit side. Income increases on the credit side, decreases on the debit side. And expenses, they increase on the debit side and decrease on the credit side. So that's just a summary of the accounts and where they increase and decrease. So now in this example of ours, they gave us a transaction. They say bought stationery on credit for 3,200. So bought stationery. So now we have to determine what account is stationery. What type of account is stationery? So stationery is an expense to the business because now we are buying stationery which we're going to use in our business. It's an expense, right? So we treat it as an expense. So when you get to like higher levels of accounting, you'll see that stationery can be either an expense or an asset. But just for the purpose of this video, I'm just going to say stationery is an expense because in grade 12, they deal with stationery as an expense. So stationery is an expense because we're paying money to receive stationery, which is an expense, right? So it's an expense to us because we have to spend money on this thing, right? So stationery is an expense. Where do expenses increase? They increase on the debit side. Since we're receiving stationery, it's increasing on the debit side because this expense is increasing, meaning that we have to pay our own money. That means this expense is increasing on the debit side. That's why we have here stationery as a debit, right? Because this expense is increasing. But when it comes to your credit now, so what happens most of the times when you buy something, we either buy it on credit or we buy it cash. If we buy it on credit, that means we have a liability that arises because we have to pay back those suppliers that gave us this stock on credit at a later stage or at a later date. So it's a liability to us, right? It's something we owe to the creditors. So usually we call this liability creditors control. So the credit is creditors control. Usually when you buy something on credit, the credit account credited is creditors control because it's a liability. And you can even think through this using our diagram here. If we say our liabilities are increasing because we bought this thing on credit, right? Creditors control, we call this account creditors control, and we say it's a liability account. Liabilities, they increase where? Because it means that our liabilities increased because now we owe more to suppliers because we took the stationery on credit, meaning that liabilities increased. Where do liabilities increase? We go to the diagram. Liabilities, they increase on the credit side. That's why you have your account creditors control, right? It's an expense. Expenses, they increase on the debit side. That's why we debit as stationery. And then the amount is 3,200, the amount they gave us here, right? And then you have your accounting equations. So if you got this thing right, and then you got this account debited and credited right, it will be easy for you to fill out this thing over here. So what I want to note is these are assets. You know where assets increase, you know where assets decrease. Owner's equity is affected by two things, which is your income and your expenses. So expenses, they decrease your owner's equity. So owner's equity is like the wealth the owner has on the company, right, in simplest form. So if we have expenses, meaning that money is leaving the business, we're paying those expenses, it means that the wealth of the CEO decreases in a way, right? Because now he has to pay money, it's leaving his business, right? So it means that wealth is decreasing. That's why I'm saying expenses, they decrease the owner's equity. And with income increases owner's equity because it means that you're getting money. The more you're getting money, the more you get wealthy. That's why we say owner's equity increases with income, right? And liabilities, you just refer to a diagram, they increase on the debit. Liabilities, they increase on the credit side, decrease on the debit side. So now we said stationery is an expense account and it decreases on the debit side. That's why we debited this account here, right? Meaning that now we know that owner's equity is affected because I said owner's equity, expenses, they decrease owner's equity, meaning that owner's equity decreased. That's why we see a minus here, meaning that it decreased by 3,200, right? And then we also have here we said this creditors control is a liability because you owe creditors more. That means our liabilities are increasing. That's why we say increase here of liabilities. So our liabilities are increasing by 3,200, right? Our assets are not affected at all. Why our assets not affected? Because there's nowhere here whereby we affected an asset account, right? And we can see this through the accounting equation. So the accounting equation usually has to balance. So it's usually asset is equal to owner's equity plus liabilities, right? No, it's liabilities. Why am I saying 4? So it's liabilities. So it has to balance, right? Our accounting equation. So what happens here is if we have 0 change in assets and then we have a negative 3,200 change in owner's equity, plus we also have an increase of 3,200 in liabilities, meaning that this side we have 0 and that side we have 0, meaning that our accounting equation balanced, right? Our accounting equation balanced. So that's our whole aim of like the accounting equation. So what you need to understand is there's accounts, different types of accounts, and with this early method, it's easy for you to see whether an account increases on the debit or the credit side. So the important thing you need to remember here is the first thing you need to know whether the account you're dealing with, what account you're dealing with. In this case, we identified as the stationery, which is an expense account. So you need to know if that account is an asset, liability, income, or an expense account, right? And then also identify the second account, which is a liability called creditors control, because we bought on credit, meaning that our liabilities are going up, and that liability is creditors control. So you also need to know what that item is. Is it an asset, a liability, and what is it increasing on the debit or the credit side? And in this transaction, what is increasing and what is not? So in this case, our liabilities are increasing. That's why we created the liability. And our expenses are also increasing because we're buying more stationery, meaning that our expenses are increasing on the debit side. And now let's continue with our questions, right? So let's just open our questions. So we have 3 transactions here. So we're gonna be following our thought process. First thing, we identify the accounts, and we identify whether the assets, liabilities, income, or expenses, and then we determine where they increase, where they decrease, and then we determine whether these specific accounts are increasing or decreasing in this case. Then we determine whether that's an account debited or an account credited, and then the accounting equation thereafter. But let's just do it right. So we have the first transaction 1.2.1, they say electronic funds transfer, which is an EFT totaling, it's an EFT of 136,000 were made to shareholders, right? Now you have to start thinking money that's sent to shareholders, it's usually in dividends. So we only transfer money to shareholders as dividends, right? So they say being the amount owing to them at the end of the previous financial year. So it's the amount owing to them at the end of the previous financial year, right? So just like I said, that the only money we owe to shareholders, the money we pay out to shareholders, is through dividends, right? When we pay out dividends. And there's a special term we use when we dealing with the money that we owe. So what happens? Let me just take you through the thought process. So the company, after making a profit, after making money, they can choose to distribute that money to shareholders in the form of dividends or to reinvest it into the business, right? Keep it in the business, retained earnings, that it's profit that was retained in the business or paid out to shareholders as dividends. So when you pay out dividends, usually it's declared, dividends are declared 2 times in a year. We have your interim dividends, so you have your interim dividends and then your year-end dividends, right? So what happens most of the time is when we declare our year-end, let me talk about year-end. When we declare our year-end dividends, what happens is we declare them and then we usually pay them at the later date, which is like maybe next year, right? So by us declaring that dividend, we have a liability, or we owe those shareholders now, right? Because we said we're going to pay you 136,000. So we have a liability now as a business to pay those shareholders that money, right? Even though we're going to pay it at a later date, right? But with interim, they declare them, and then maybe somewhere before the year end, we pay them, meaning that the bank will be affected and stuff like that. But with the year-end dividends, usually the bank is not affected, but a liability account named shareholders for dividends is affected, right? So this liability account is called shareholders for dividends. So this is the money we owe shareholders at the financial year end when we declare this year-end dividend, but we only pay it in the next financial year, which is next year, right? So now we know that since they're talking about the amount that we owe to shareholders, we know that one of the amounts that were affected, one of the accounts that were affected here is shareholders for dividends. So I can just say, let me just type it out. So we have one of the accounts is shareholders for dividends, right? And then another account that was affected here is an account called bank, right? Since we're paying cash, right? We're paying cash to the shareholders. EFT, that means we're sending cash in our bank. The money in the bank decreases, right? So this money in the bank decreases. When it decreases, that means our bank is affected. So now we've identified the 2 accounts that are affected by this transaction, right? Which is your shareholders for dividends, and we also have bank because money is leaving our bank account, right? So let's classify these accounts. Bank, it's an asset. Since I said cash, it's an asset. So bank, it's always an asset account. And shareholders for dividends is a liability. I've explained why this is a liability, because these are the dividends we declared previous financial year. And then we had a liability to pay this to shareholders. We're owing shareholders this money, right? So this is called shareholders for dividends, right? Which is a liability. Sorry for putting an A here. It's a liability, right? We just say liability. So you go back to your diagram, right? So now let's determine, we've identified the accounts and then identify whether they are assets or liability. Now let's see what increases, what decreases. We're paying money, meaning that our bank decreases, our bank balance decreases, meaning that our assets are decreasing. We go back to our diagram. Where do our assets decrease? Our assets, they decrease on the credit side, meaning that the account that will be credited is your bank figure. Let me just scroll through here. I think I have the solution. Yeah, so I can just put the solution here, right? And say, okay, the account that's going to be credited with your bank. Why? Because cash is decreasing, right? Money is leaving our bank, which is an asset. And we said assets, they decrease where? They decrease on the credit side, right? Shareholders for dividends, the liability, we owed the shareholders. But now since we paid them, meaning that our liability decreases, we no longer owe these shareholders, right? We no longer owe them money. We've paid them off, meaning that our liabilities, they decreasing. Liabilities are decreasing. Just as bank decreased, our liabilities are also decreasing. Where do liabilities decrease? They decrease on the debit side. So we're going to debit what? A liability called shareholders. So it's called shareholders for dividends. Let me just say shareholders for DV. Let me just say div, right? So it's called shareholders for dividends, right? And then the amount is 136,000. They gave us the amount. And I've already spoke through the accounting equation. I said this one is a liability account, right? And since our liability are decreasing because we no longer owe the shareholders, it means that we see a decrease here in our liabilities. Bank is an asset account and it's decreasing because cash is leaving our accounts, meaning that we have a decrease here of 136,000. But there's no effect on owner's equity. Remember, I said this is only affected by income and expenses. And in this case, we don't have any income or expenses because what's affected is a liability account. We owe the shareholders. Now we settled that liability, paid off those shareholders. And the bank is an asset. Cash is leaving the business, which is an asset, and it's decreasing. That's why I only have an effect this side and this side. And then the equation balances will have a negative 36 on the debit side and negative 36 on the credit side. Hope that's useful. So let's go to 1.2.2. So with 1.2.2, they say the company received 450,000 for the issue of new shares, right? They issued shares and then they got 450,000. They got money. That's our starting point. If they got money, meaning that they received money, it means that they bank is affected. Bank is affected. And remember, bank is a what? It's an asset, right? Let me just move this one so that you can see that, okay, this one was dealing with number one. Was dealing with number one. Then we have a decrease and a decrease. So with number two, we have bank. Since we're receiving money, bank is affected, right? Bank is affected, which is an asset. Receiving money means that our assets are increasing. This cash is increasing in our bank account, right? Where do assets increase? Go back to our diagram. Assets, they increase on the debit side. So the more you refer to this diagram, the more it's going to come to you easy to remember where assets increase, where liability increase. So the increase where on the debit side, we can just go and jot that in really quick and say, okay, our bank are increasing and bank is increasing on the debit side. So it will increase on the debit side here, the debit bank, the account bank. And then you say, for the issue of new shares, what's the other account that's affected here? So we have what we call ordinary share capital. Ordinary share capital, which is an equity account. So we must have done this account over here. Whenever we issue our shares, we increase the ordinary share capital account, right? And equity, it increases on the credit side. If you remember, equity, it increases on the credit side, and then it decreases on the debit side. So there's no equity in this early method, right? There's no equity because equity is a separate thing. I haven't included here, but I just summarized that income and expenses, they affect equity. But what I want you to remember is that ordinary share capital is an equity account, and it increases on the credit side, and then it decreases on the debit side. So equity, since we issued new shares here, it means that there's an increase in our shares in issue, meaning that this account will increase on the credit side, right? So our equity already always increases on the credit side, ordinary share capital. Whenever we issue out shares, we credit ordinary share capital. Let me just say capital. So ordinary share capital is an equity account which increases on the credit side, decreases on the debit side, right? And since now we can do our accounting equation, is 450. Bank, I said it's an asset, and since we've received cash, it's increasing. And ordinary share capital is an equity account which increases on the credit side. That's why I created ordinary share capital, meaning that our equity is increasing. And then there's no liability here because we don't owe anyone cash. We don't owe anyone cash, right? So our accounting equation balance, because we have an equals to sign here, or let me just throw it equal to sign here. Our left-hand side will be plus 450. Our right-hand side will be plus 450,000, right? And we can move to 1.3. So with 1.1.3, they say the income tax assessment for the year was received. The income tax amounted to 338,200, right? So let's start there. Income tax is an expense to us because we have to pay money to SARS, right? So income tax, that's our first account, income tax, which is an expense, right? An expense. Let me just state it here and say expense. And expenses, they increase where? They increase on the debit side, right? So this income tax, since we incurring expenses, which is called income tax, will increase on the debit side. So we'll have income tax here. Income tax, right? As your debit. Then what will be our credit? So we have this account called SARS. Let me just see if I'm writing. No, so it has to be in caps. So we have SARS income tax. So people usually refer to this account as a liability account, right? But it can be both a liability and assets. So usually what happens is, let me just explain this thing of SARS income tax account. So it's SARS income tax account. So what happens is during the year, what we do is we pay provisional tax payments, right? Provisional tax payments. Since this is a liability account, it means that we owe SARS, like the money that we owe SARS will go their side. So whenever we receive our tax amount, we just put it on the credit side. Remember, liabilities, they increase where? They increase on the credit side. If you can refer to our diagram here, liabilities, they increase on the debit side. So since this SARS income tax is a liability account, we credit it whenever the liability we have from SARS arises. So what happens is that during the year, we make provisional payment to decrease the amount payable to SARS at the end of the year, right? So during the year, we're trading, and once SARS at the end of the year determines, at the end of our financial year, determines, okay, this is how much tax you need to pay. It's usually 28% of our net profit, right? So they say, okay, this is like 28% of our net profit. It amounts to 338,200. So this is the amount you're supposed to pay to SARS at the end of the year. But what we do as a business, we usually pay provisional tax payments during the year to decrease this amount payable at the end of the year. Maybe we'll pay 100,000 during the year, pay another 100,000, so that we can decrease this amount over here, right? So here they say the income tax assessment for the year was received. The income tax amount to 338,200 exceeded the provisional tax payment made, right? So I think we'll deal with this properly when we deal with this account of SARS, but usually what happens when the amount that SARS determines as income tax at the end of our financial year exceeds provisional payment, we have additional liability, meaning that we still have a balance we need to pay over to SARS, right, which is a liability. But we'll get to that, right? Get to that. But what happens here is, since we're saying this SARS income tax liability, whenever SARS determines that, okay, this is the income tax payable, we have an expense which increases on the debit side, income tax, and then we increase the liability called SARS income tax. So we have a liability called SARS. So the liability is called SARS income tax. So this is the liability, right? And then it's 338,200. And I said this is an expense account. An expense account, they decrease our owner's equity, right? And this is a liability account because now we owe SARS money, right? We owe SARS money. That means we increase our equity balance, right? Increase not our equity, our liability, since we owe SARS money, and then assets are not affected in this case, right? Income tax is an expense, meaning that we have to pay SARS, and then it decreases owner's equity. Then SARS income tax a liability account, meaning that we owe SARS money now, so it's a plus here. So now let's do our last question, which is 1.3, right, which is on independent audit reports. So this is one of the simplest sections in grade 12 accounting because they ask you almost the same question each and every year. They ask similar question. So they say you are provided with the extract of the audit report for Rockstone Ltd for the financial year ended 28 February 2021, right? And then they say identify the type of audit report that the company received, give reasons for your answer. So there are three types of audit report that a company can receive, which is a qualified audit report, unqualified audit report, and then a disclaimer of opinion. So qualified audit report, that's when the report has errors, right? The report has certain error or a certain calculation errors or certain things omitted on it, and then the financial, so the auditors, they come, the audit, and then they pick up these errors, and then they say, okay, our audit opinion, it's a qualified audit report because we picked up this error and this error that needs fixing, right? And then with an unqualified, don't get this confused, right? Unqualified, that's when we say, okay, this audit report, it's okay, it has no errors. We have checked it against our international financial reporting standards, our company act, and then this report is clean, no errors at all, no omissions, nothing, right? These financial statements are like good to go, right? And then we have a disclaimer of opinion. Disclaimer of opinion, that's when auditors, they suspect that there's something shady going on here. They don't understand. There are a lot of omissions. These financial statements are just off, right? They don't follow the international financial reporting standards. That's when they offer a disclaimer of opinion. They don't even want to express their opinion on these financial statements because they find them shady, or they find them that they're not in line with IFRS, which is our international financial reporting standards, right? So, and then let's just read this thing through and then we'll answer the questions after. So they say, to show us basis of opinion, we conducted our audit report in accordance to the international standards of auditing. We are an independent of the company. So remember that auditors, external auditors, have to be independent of the company so that they can audit, right? They can provide assurance to show us that these financial statements are fairly presented, they have no omissions, they have no error. As applicable to performing audits, and we other ethical requirements as per the professional code of conduct, the audit evidence we obtained was sufficient and appropriate. Opinion, we have audited the financial statement as set out in page 8 to 23. This compromise statement of comprehensive income, statement of financial position, and cash flow statements for the year ended 28 February 2021. In our opinion, this financial statements present fairly in all material respects. The financial position of the business as at year then ended, its financial performance and cash flows in accordance with international financial reporting standards and the requirements of the Company Act South Africa, Peru, and what, and then they sign the date and all those kind of things, right? So these are the key things to take over. So shareholders, what they do is, let's just answer the questions and then I'll explain the audit report after. So they say identify the type of audit report. So this is an unqualified. Why? Because I said if these financial statements are fairly presented according to IFRS and then there are no errors, there's nothing, that means it's an unqualified audit report. So in this case, we'll have an unqualified audit report. Why? They said provide the reason for your answer. They said provide a reason for your answer. So why? Because the financial statement presents fairly in all respects the financial position and performance of the business. That's your reason. Or you can say because there are no errors that the auditors picked up during the audit process, like no errors in the financial statement. That's why you say it's an unqualified, right? So you can just write it down. It's going to be unqualified, unqualified audit report. Yeah, so it's an unqualified audit report. And then gave you the reasons, and then they say explain why the auditors referred to page 8 to 23. So here they said we have audited the financial statement as set out in page 8 to 23. So this is like a way of them stating the limitation of their duty. The financial statements that they audited are set out in page 8 to 23, right? That are the only pages that they audited. So you'll say this is a way of the auditors expressing limitation of their duty, meaning that the audited financial statement can be found in page 8 to 23, right? That's how you explain this thing of pages, meaning that the audited financial statements are found in these pages, right? Which is page 8 to 23. Why did the auditors refer to the International Financial Reporting Standards and the Companies Act of South Africa? So this is because this is a way to show shareholders that, okay, because this is a statement, this is a report that's sent to shareholders by auditors to assure them that, okay, these financial statements are legit, are okay, are valid, right? They compromise of information that's useful to you guys and that's accurate, right? So they refer to International Financial Reporting Standards and Company Act so that they can show that, okay, the financial statements, they meet the requirements of both international and local requirements or laws, right? That's why they mention this too. They meet both international and local laws. And with, or you can say, this IFRS or International Financial Reporting Standards and Company Act, they affect the reporting or the financial statements because companies need to follow these standards in preparing of their financial statements. Right? So if they say they are in accordance with the standards, it means that they are presented fairly and they are accurate and valid, right? And that's why they state those are some of the few reasons why they stated International Financial Reporting Standards and the Companies Act. Then last question, they say name any 2 items of audit evidence that the auditors may have used, right? So audit evidence, it can be anything. It can be source documents. It can be like a physical inspection of inventory whereby they count inventory or the asset register, they check asset register, the assets that the businesses have, whatever it like, it's any information that they can use in order to perform their audit. So the 2 I can say is that source documents, and it can also be the physical inspection of inventory or assets, the asset register, and so on, right? Thank you for tuning in. I hope I helped you genius up with accounting. More videos are coming, so you can kindly hit that subscribe button, and I'll see you next time.